Hey folks, welcome to the Taylor Tax Show. I'm Terrence Taylor, the co-founder of Taylor Tax. This is my partner, Big Al Darnell Jr. Say what's up, Big Al?
What's going on, everybody?
And as you know, this podcast is all about helping highly paid, highly taxed, high profile, and now ultra high net worth or high net worth taxpayers save a bunch on taxes legally. Today, episode 16, we are going to tell you how to master the tax code. And we're going to do so in 15 minutes or less. That's our promise to you.
All day.
Big preview for you. It's all about Pepsi, not the drink, though.
Exactly.
So let's kick this off, Big Al.
Hey, what's going on, everybody? So here's the thing. How to master taxes in 15 minutes or less. The first thing that you need to know is what is taxed? Income. What is not taxed? Debt. And we're going to get more into that a little bit later on.
Mhm.
Now, here's the thing that you need to understand. Every time money or value usually is exchanged or changes hands between a U.S. resident or anyone associated with the U.S., the IRS is entitled to a piece of it, a la taxes. Now, the thing is if it's income to one person, then it's an expense or should be an expense to the other with a couple of qualifications. Nonetheless, that's the basis of how this thing is, how the Internal Revenue Code works. All right. So the qualification of all this, though, is how it's recorded and what you need to make sure. And this is why tax professionals tell you all the time to keep up with your receipts or to do less and less cash transactions so that you can have a record of this expense to you so that you can write it off. And a lot of times, a lot of companies or small businesses might not even accept anything other than cash because they want to avoid this record of income. But nonetheless, the IRS categorizes income. And this is where Terrence is going to explain a little bit more about Pepsi.
Folks, this is where it's all about Pepsi. But again, not the drink, right? So the first thing is this. The IRS categorizes money into either passive income, earned income, portfolio income, or capital gains. Now, the one thing you have noticed is 3 of the 4 have the word income in them. And this is Big Al's point earlier. So as long as it can be categorized as income, then you are going to pay taxes on it.
Correct.
And when it's a capital gain, you are going to pay tax on it. Now, the beautiful thing, Big Al, is we know that the tax code actually has a range of how much you can pay on any of these categories of the four Pepsis, right? So let's start with passive income. So Big Al, when you make money and you can categorize it as passive, the IRS is likely to tax you anywhere from 10% all the way up to the highest bracket, which is 37%. So 10 to 37%.
Correct.
All right. Now, where we come in as tax strategists is we make sure you know what to do to get in that 10% category. Because you tell me, what would you rather pay, 10% or 37%? 10% all day, Big Al.
100%. 100%.
Let's talk about earned income. Earned income, same thing. And this tends to happen with folks who are working, right? When you're a W-2 employee, like I used to. So you, again, depending on your category, depending on your tax bracket, you can pay as little as actually 0, right?
Yeah.
Or as much as 37%.
Yeah.
Right? So that's earned income. What about portfolio income, Big Al? This is an interesting category.
Yeah.
So here you have things like dividend income, interest income, and the king of portfolio income is actually Warren Buffett. So many, but like Apple is one of them.
100%.
And we were talking about this, folks, right before we jumped on this podcast. Did you know that in 2023, Steve Cook made $63 million?
Actually, it's Tim Cook.
Oh,
Yeah.
I'm still thinking about Steve Jobs, y'all. Yeah, you're so right. Tim Cook made $63 million in compensation from Apple.
Correct.
How much did Warren Buffett make in 2023?
This brother, just from Apple alone, Apple dividends, I believe he made almost $1 billion, $987 million in just Apple dividends.
Folks, Big Al is correct, but the numbers are just slightly inverted. $879 million, but it's still close to $1 billion. He ain't worked one day in Apple, but as an investor who got portfolio income, he got 879
100%, and because it was qualified dividends, it's taxed at 15%.
Exactly, right? So that's the beautiful thing. So portfolio income allows you to be taxed at certain rates, right? So again, you go from as low as,
well, all ordinary income starts at 10%,
right? So
but
as low as 10%.
A lot of these things can be brought down to zero.
Right?
10 to 37.
10 to 37. Now let's talk about capital gains, the C part of Pepsi. So capital gains is all about when you have an asset and now you're in a position where you have sold the asset and you're going to realize value on the asset. And we're not going to get into like all the definitional things that make it a capital gain, but just know that if you gain something after you've invested your money, the IRS wants to tax you.
Yeah, it grows in value.
Here's the beautiful thing.
Yeah.
You could pay as much as 20%.
25.
Is it 25 now?
Yeah.
I love that.
Yeah.
You can pay as much as 25% on capital gains or as low as 0%. You got to love that.
100%.
So what we're trying to say is this. Once you understand what Pepsi's all about, now, Big Al, let's talk about where mastery comes in, the tax code. Let me hand that back over to you.
Definitely.
How do folks use Pepsi to master the tax code?
Well, here's the thing, and I used to teach a finance class, and what I would tell all my students is the entire premise of personal finance is to convert your earned income into passive and portfolio income. Now, that was looking at it from purely an income standpoint, but now looking at it from a tax standpoint, what you need to do is you need to master this one thing called value, and understanding how to use your value. So the value is the epicenter, the apex of everything that you want to obtain. Value is where cash flow creates value, but value, you can either earn income from it or it's in a form of equity that you can borrow from. And like I said at the very onset of this podcast, what is taxed? Income. What is not taxed? Debt. So as long as you have this value, this equity that you can pull from, usually in the form of debt, then you can receive that to use on any aspects that you want in life, hopefully other investments or other life expenses. And you won't have to be taxed on. But based on the assets that you're using, it can grow in value so that you can keep pulling from it. So this is how the wealthy stay wealthy and the rich get wealthy, and those that aren't rich get wealthy as well. Is that what you have to do is you have to take your value, convert it into an asset that also creates and builds value, borrow from that asset, and then operate your life on that. And a lot of times, the wealthiest people in the world are not wealthy because of the amount of income that they make. They're wealthy because of the amount of value they created, usually through a company, usually through the stock. Like what he was talking about with capital gains, it grows in value. So that is primarily how you master the tax code. You master the tax code, you master taxes by living outside of what's being taxed, living outside of income. If you live outside of income and you live inside the value that you've created by pulling on the debt, using your equity as a collateral, then you don't even have to pay taxes anymore. Not, in the grand scheme of things, income tax. You're still going to pay sales taxes, for property taxes, but still, that's the way to master the tax.
So that's Pepsi, folks. So once you understand Pepsi, you do your best to stay on the C side, right? Or if you prefer portfolio income like Warren Buffett, then you're making a technical term, a shit ton of money and saving a shit ton on taxes. And the last thing that I'll share is I used to naively think that when I saw folks like Mark Zuckerberg or Larry Page and Sergey Brin taking like $1 in salary, I was like, man, they really love their company and they're passionate about their company, and that's why they're doing it. I learned it's an and. Of course they love their company. Of course they're passionate about their company. And isn't it beautiful that when they take $1 for their compensation,
Mm-hmm.
they're in the zero tax bracket when it comes to income?
Earned income.
Earned income?
Yeah,
right?
definitely.
So
Definitely.
they do good and they're able to save a shit ton of taxes. So, folks, yeah,
100%. Because see, what the thing is what's taxed the highest
Yeah.
is usually earned income.
That's it.
Now, the thing is, passive income is
Mhm.
also taxed on the ordinary
Mhm.
income tax range,
Mhm.
but they have restrictions.
Mhm.
All right, they have restrictions on what you can write off, so on and so forth. But the key with
Mhm.
what he was talking about,
Mhm.
why these billionaires are taking these very tiny, minuscule salaries,
Mhm.
is so that they can avoid the 37% income tax bracket.
Yeah.
And capital gains is going to be taxed at most 25%. And then also with qualified dividends and certain portfolio income, it's going to be taxed at 15%. Or zero. Yeah, yeah. But if you shift this income out of the earned income category,
Mhm.
that's going to help you profusely in the entire tax game. All right? Because with earned income, you can't even subtract expenses off of it. You can only subtract contributions to qualified accounts like retirement accounts and so forth, or traditional IRAs. However, the key is to get your money out of that earned income category and then ultimately to get it out of the income category at all
costs.
Yeah.
And so the last thing I wanted to share, because we've talked about buy, borrow, die before. That's why you have folks like Elon Musk, who, depending on the day or the year, is the richest man in the world, like in the top 3. And he does not do anything other than take his assets and borrow against his assets. And then he's living that tax-free life because he has debt. Debt's not taxed. All right, folks, we could go on and on and on, but we promised you in 15 minutes or less. It's actually 12 minutes on the clock. And we just want to share with you that if you want some more information about what we've covered, get in touch with us. Terrence at taylortax.ai or Big Al at taylortax.ai.
And also check out Tax Strategies GPT on OpenAI's website. Please give it a gander, give it a try. I think it's absolutely brilliant. My partner over here actually built the thing, and kudos to him. So
True story.
Give it a try. Throw in some scenarios in it, and I'm certain you'll be impressed.
We just want to make sure that you get the information you need, folks. So remember, when you're highly paid, highly taxed, high profile, high net worth, or ultra high net worth, and want to save a bunch on your taxes, we got you. Taylor Tax. All right, folks. See you soon.
Cheers.